In this section of our course, we're going to cover special partnership issues, and we're going to start with non-liquidating distributions. The basics of non-liquidating distributions we have covered in the last chapter, and the basics will apply unless Section 751 applies. So first we'll quickly run through the basics, and then we'll run through Section 751. So unless 751 is triggered, no gain is recognized on distributions that do not exceed a partner's basis in the partnership. This is our general rule. We've talked about it before. The distribution can be cashed, deemed receipt of cash from a reduction of liabilities, fair market value of marketable securities. If we have a pre-contribution gain or loss, that changes the result just a little bit. A pre-contribution gain or loss, remember, is when a partner contributes an asset that already has, if the asset was sold for fair market value on the date of contribution, there would have been a gain. But we know that the code does not require us to recognize that gain as long as all the code section requirements are met on contributions to partnerships. So if we have an asset with pre-contribution gain or loss, and that asset and that contributing partner later will recognize that gain or loss when or if that property with the pre-contribution gain or loss is distributed out to another partner within 7 years. The partner's basis in the partnership would increase by the gain, and the partnership's basis in the asset will also increase the gain. So this is a case, like we said, where an asset is contributed by a partner and that asset has a built-in gain or loss at the time of contribution. These rules would kick in if that asset is later distributed to a partner within 7 years of contribution. Also, property distributions to partner with pre-contribution gain, that's covered in Section 737. That partner would recognize a gain to the lesser of the remaining pre-contribution gain or the excess of the fair market value of the distributed property over the adjusted basis of the partnership interest immediately before the property distribution after reduction for any money distributed at the same time. So again, this covers the partner who made that contribution of a pre-contribution asset, pre-contribution gain or loss asset. Looking at problem 25, Andrew contributed investment land having an $18,000 basis and a $22,000 fair market value along with $4,000 in money to the ABC partnership when it was formed. 2 years later, the partnership distributed the investment land to distributed the land Andrew had contributed to Bob, another partner. At the time of the distribution, the land had a $21,000 fair market value, and Andrew and Bob's basis in their partnership interest were $21,000 and $30,000 respectively. A. What gain or loss must be recognized on the distribution, and who must recognize it? So we know that there's going to be a gain because there is a pre-contribution gain. So when Andrew contributed this land, there was $4,000 of gain built up in this asset. If Andrew had sold the land for $22,000 on the date of contribution, he would have recognized a $4,000 gain. But at the time this land is distributed to Bob, there's only $3,000 of gain in the asset. So we're going to recognize gain, and Andrew is going to recognize it, and it is going to be $3,000. So $3,000 gain by Andrew, he must recognize it, so that gain will be allocated to him. B, what are the basis for Andrew and Bob's interest in the partnership after the distribution? And C, what's Bob's basis in the land? Okay, so our general rules of figuring out basis are going to apply here. Andrew started this problem with a $21,000 basis in his partnership interest. Andrew is the one who contributed the land, and Andrew is the one who had to recognize the gain. So he started with $21,000, and because he had to recognize this gain, his basis increases by $3,000 to $24,000. Remember, Bob started this problem with a $30,000 basis in the partnership. And we know that distributions decrease partners' basis in the partnership, the outside basis. So Bob started with a $30,000 basis in the partnership. Bob receives a distribution of land. The deemed distribution amount is $21,000. So we subtract that $21,000 from the beginning $30,000 basis to leave Bob with a basis in the partnership of $9,000. The $3,000 gain does not affect Bob's basis. Bob takes a $21,000 basis in the land. All right, continuing on with non-liquidating distributions, the partner's basis for property distributed by the partnership carries over. We just saw this in this problem. It carries over. It started with 18 and we increased it by the amount of gain recognized. So total basis of all distributed property is going to be limited to the partner's pre-distribution basis in the partnership interest plus gain recognized on the distribution. So that's what we had there. Remember that land had a basis of $18,000 to the partnership. It carried over to Bob, and then it was increased by the gain. So the basis of the land to Bob was $21,000. The partner's basis in the partnership is going to be reduced by the amount of money received and by the partner's basis in distributed property. And then the partner's holding period of distributed property is going to include the holding period of the partnership. If the property is unrealized receivables to the partnership, collection is going to be ordinary income to the partner. And so remember, unrealized receivables are receivables that are owed to the partnership but haven't yet made their way into income. And so that usually would happen if we had a partnership who used the cash basis of accounting. And so they're owed money for work they've done, services they've performed, something like that, but they haven't been paid. Since they haven't been paid and they're a cash basis taxpayer, that amount hasn't hit income. So if property distributed out is unrealized receivables to the partnership, then the collection or the sale of those is going to be ordinary income to the partner, not capital gain. Likewise, if property is inventory in the hands of the partnership, the partner would recognize ordinary income if the property is sold within 5 years. So ordinary income rather than capital gain. Now moving on to Section 751. So this is going to change our normal distribution rules. And if Section 751 applies, we're going to have gain or loss in this distribution. So Section 751 assets are often called hot assets because they produce unfavorable tax consequences for partners. Section 751 assets include unrealized receivables and inventory. But the definition of unrealized receivables and inventory for this section's purposes is much more broad than what we're thinking of right now. Unrealized receivables are defined as the right to payment to be received by a partnership to the extent it is not already included in income. So that's probably the definition we think of. That's what I just said. But it also includes most potential ordinary income recapture items. So remember Section 1245 and 1250 depreciation recapture require recognition of ordinary income if I have taken depreciation on certain assets and the gain is attributable to that depreciation. So those are also going to be considered 751 assets. Inventory is also a 751 asset, and an inventory for this purpose includes items held for sale in the normal course of partnership business. Other property that, if sold by the partnership, would not be considered a capital asset or 1231 property, so all ordinary income property. Other property held by a partnership that, if held by the selling or distributee partner, would be the property of the two types listed above. So basically, cash, Section 1231 property, and capital assets are the only property that are not inventory for these purposes. So the only property that are not 751 property. However, inventory is only Section 751 property if it's substantially appreciated, and that's defined as the fair market value of the inventory exceeds 120% of the adjusted basis to the partnership. But when we're calculating this, we include the value of unrealized receivables. So we include the value of all of these things on this slide. Section 751 applies only if the partnership has Section 751 assets and exchanges 751 property for non-751 property. So we have to have both types of assets, Section 751 and non-751 assets, and then we have to exchange them for other types of property, and the exchange is going to be disproportionate between the partners. So in the second bullet, Section 751 does not apply when a distribution is proportionate to all shareholders, or if it consists of only the partner's share of either 751 property or non-Section 751 property and does not reduce the partner's interest in other property. And we'll run through some examples of this. So again, a simpler way, when does it apply? When does Section 751 apply? Well, it applies when there is a distribution to a partner. The partnership owns two classes of property, hot assets and non-hot assets, and it's a disproportionate distribution. So it's not distributed in proportion to the partner's ownership interest. If it applies, then the distributee partner may recognize gain or loss. The gain or loss may be ordinary income or loss, whereas gain under the general rule is capital. The partnership may recognize gain or loss. The partnership's adjusted basis for its property may change. Okay, so your book lists these step-by-step way of computing Section 751, and we will go through these, and then we will go through a problem to kind of apply this. So step one is divide the assets into 751 and non-751 assets, and this is when we would test the inventory to see if it meets that 120% rule. Step two is develop a schedule to determine whether the partner exchanged Section 751 assets for non-751 assets or vice versa. Step three, determine whether Section 751 assets were exchanged for non-Section 751 assets. Step four, determine gain or loss on the deemed sale rule. And step five, determine the impact of the current distribution. Okay, so I pulled this example. Obviously, this is not mine. It's from Crow-Horath's training, and I pulled it from there, but I thought it was a good illustration of Section 751. So here, John, Paul, and Ringo are equal partners in a partnership, and John wants to retire, but there are some hot assets on the books. Here's what they have right now. They have cash and inventory. So we know that inventory is a 751 asset if it is substantially appreciated. So down here at the bottom, you can see inventory has substantially appreciated because its value exceeds 120% of its basis. So we can see that its value is $6,000, its basis is $1,500. That's more than 120% increase. So we have 751 and non-751 assets. The fair market value of the assets are $18,000, and John, Paul, and Ringo are equal partners, and so if we divide this up, they have equal adjusted basis of $4,500 in the partnership and $6,000 of fair market value. Okay, so again, John wants to retire. So we agree that John is going to receive $6,000 in value of the partnership assets because that's a third of the value of the partnership. So he is owed $6,000 of assets, and we have cash and we have inventory. If we were going to proportionally give John what he is owed of each asset, we would give him a third of the cash and a third of the inventory. That would be $4,000 of cash and $2,000 of inventory. I could do that, or I could give him more than I could give him all inventory, more inventory than his share. I could give him all cash, right, which would give him less inventory of his share. I have a lot of options, and it doesn't really matter as far as value what I give him for partnership purposes. He's owed $6,000 in value. It may matter to John. He may want the inventory or he may just want the cash, and it's going to matter for tax purposes because these are hot assets. So let's go, if looking at Scenario 1, actual shares in both classes. If we were to distribute $4,000 of cash to John and $2,000 of inventory to John, Section 751 would not apply. And it would not apply because John would have received a proportionate share of distribution. 751 is only going to apply when it's a disproportionate share of distribution. So these next few slides are going to talk about a disproportionate share. So here, under this scenario, we're going to distribute $6,000 of cash to John. This is probably the easiest thing to do just from a practicability standpoint, because John probably doesn't want inventory. He probably just wants cash. He wants to cash out of his partnership interest. But the problem is this is not proportionate. So this is a Section 751 taxable transaction. We're going to pretend like John sold his share of the inventory for the consideration actually received. So this didn't really happen, but we are pretending now. We are pretending like John received $4,000 of inventory, $2,000 of cash, and sold his inventory back to the partnership in return for cash. If he did that, even though he didn't, if we pretend like he did that, then the remaining partners would be considered to have purchased John's share of the hot assets relinquished in return for the property actually distributed. So here's what it would look like. Even though he received all cash, he is treated as having received $4,000 of inventory and $4,000 of cash and $2,000 of inventory. And you can see down there the inventory has an adjusted basis of $500. So we're going to pretend like he sold the inventory back to the corporation for $2,000 cash. So what's going to happen is he sells this inventory and he has a $500 basis in that inventory because that's the transferred basis from the partnership. So he's going to sell the inventory, pretend, for $2,000. He is going to have a $500 basis, which is going to require him to have $1,500 of gain. That gain is going to be taxed as ordinary income because the inventory would produce ordinary income. The partnership would have no gain or loss, but because it's going to have been deemed to have used $2,000 of cash to purchase his inventory, and that would not be a taxable transaction to the partnership. So now the partnership has an additional $2,000 of basis to add to the inventory, and John has a $1,500 gain that's taxed as ordinary income. Now under scenario 2, John receives $6,000 of inventory. Remember, we pretend like he received $4,000 of cash and $2,000 of inventory, and then he traded his cash for more inventory. He bought more inventory from the partnership. That's not really what happened, but that's what we deem to have happened for tax purposes. So that excess distribution of hot assets means that Section 751 applies. And again, John is considered to have traded his share of the relinquished non-hot assets, the cash, for the consideration he actually received, the inventory. So if he had gone out and bought inventory with cash, he wouldn't have a tax consequence, but the partnership would have a tax consequence. So the remaining partners are considered to have purchased John's share of non-hot assets relinquished in return for property actually distributed. So again, John is treated as having received $4,000 of cash, and with this cash, he's deemed to have purchased 2/3 interest in the inventory. That other $2,000 of distributed inventory represents John's share of the hot assets before distribution. So again, John's original basis, this is LLC. It can be an LLC. Right now we're going to just say it's a plain partnership. John's original basis in his partnership interest is $4,500. It's going to be reduced by his deemed cash distribution of $4,000. So his basis after that is $500. That's going to be his basis in the inventory. And then remember, we treat it like he went out and bought the inventory from the partnership for $4,000. So now his basis in the inventory includes the basis in the distributed inventory and the basis in the purchased inventory. So the total basis is $4,500. The partnership is going to be treated as selling 2/3 of its inventory to John for $4,000. So the partnership is going to have a gain or a loss. Here it's going to be a gain. And they'll recognize ordinary income of $3,000. It's the fair market value of the inventory sold minus the basis of $1,000. And the gain will be allocated to the partners, Paul and Ringo, which of course will increase their basis. Looking at problem 1027, we have the KLM partnership owning the following assets on March 1st of the current year. A, which partnership items are unrealized receivables? So we can see here that the receivables are obviously unrealized receivables because we have no basis in them. We also are going to have, in the equipment, we're going to have some depreciation recapture. I know that looking at footnote A, it says the partnership has claimed depreciation of $4,000 on the equipment. And the equipment, the Depreciation recapture would be section 1245, depreciation recapture. That means if I sold the equipment, I would recognize gain, and the gain would be ordinary gain to the extent of depreciation taken. So here I have up to $4,000 of section 1245 recapture. Right now, though, it's only $1,500 because, as you can see, the value of the equipment is $10,500, but the basis is $9,000. So there's only $1,500 of gain in there. So the unrealized receivables are going to be the accounts receivable and the depreciation recapture. That isn't all the Section 751 property, though. Remember, inventory is Section 751 property, and also anything else that would be ordinary income property if sold. So supplies are also going to be ordinary income property if sold. So I also have inventory and supplies. B is the partnership's inventory substantially appreciated. Remember, when running this test, our test is 120% over adjusted basis, but we consider both unrealized receivables and inventory in running this test. So in this problem, we're going to look at the fair market value of the receivables, the inventory, the supplies, and the amount of 1245 recapture. So yes, it does meet the test. The inventory's fair market value is $76,000. You can see that's a $16,000 fair market value from the receivables, the $52,000 of inventory, the $1,500 of depreciation recapture, and the $6,500 of supplies added up. That's the fair market value. It exceeds 120% of the basis, and the basis of each asset is 0 for the receivables, $50,000 for the inventory, $6,000 for the supplies, and of course 0 for the recapture. So the total adjusted basis is $67,200. So, well, I'm sorry, that's not the adjusted basis. That's 120% of the adjusted basis. So it's 1.2 times 56,000 gives me 67,200. If the fair market value is greater than that, then we meet the 120% rule and the inventory is substantially appreciated, meaning it is Section 751 property. C, assume the KLM partnership has no liabilities and that K's basis for her partnership interest is $33,750. On March 1 of the current year, K receives a $20,000 distribution in cash, which reduces her partnership interest from a 1/3 to a 1/4 interest. What are the tax results of the distribution, the amount paid in character of any gain, loss, or income recognized in K's basis in her partnership interest? So we know this is going to be a 751 tax problem because we have hot assets and non-hot assets, and we can tell that this was not a proportionate distribution. I can tell that because she only received cash. So she didn't receive a share of each of these assets. So we know we're going to have a Section 751 issue here. And this is the chart mentioned in your book when they said to go step 1, step 2, step 3 in the 751 problem. So this is what it looks like. We start by dividing the assets into 751 assets and other assets. So that's that first column. And then we take the partner who received the distribution, we take that partner's interest before and after the distribution. So in column 1, K had a 1/3 interest in the partnership. And after the distribution, she had a 1/4 interest in the distribution. So of all of these assets, we allocate her share in each of these columns. So of the receivables, we literally divided it by 3. 16,000 divided by 3. We went all the way down the column and did that for every asset. This was her interest in these assets before the distribution when she was a 1/3 owner. In column 2, she is a 1/4 owner. So we did the same thing. We took the receivables and divided them by 4. We went all the way down, right? And in step 3, this would be the distribution had the distribution been proportionate. So had she received $20,000 of assets in proportion to her reduction in ownership, this is what she would have received. We know that's not what she received. Her actual distribution is in column 4. She actually only received cash. So the difference is in column 5, all right? And we can see here the difference is $6,333. and that is going to be her deemed distribution of hot assets. So again, she is going to have deemed, we're going to pretend like she sold $6,333 of hot assets back to the corporation for cash. So she is going to have gain or loss on this transaction. All right, and this is what it's going to look like. Remember, she sold it back for cash. She realized $6,333 of cash. The adjusted basis in those assets is calculated in footnote A for you. There was no basis in the receivables, $4,166 in the inventory, $500 in supplies, and none in the recapture. And then the difference is going to be her recognized gain, which is going to be ordinary income. Now her basis in the partnership started at $33,750. We take away the distribution of the Section 751 transaction. So we take away the inventory and the supplies. That will add up to her adjusted basis of the $4,666 to get her basis after the 751 assets. Then we subtract the non-Section 751 distribution. So that's calculated in footnote B. $20,000 total cash is what she got. We subtract out what she deemed to have received as a Section 751 asset, even though she didn't. The rest of that is that $13,667. She's left with a basis of $15,417. All right, looking at 29. The PQRS partnership owns the following assets on December 30th of the current year. Cash, receivables, and inventory. Obviously, receivables and inventory are 751 assets. The partnership has no liabilities, and each partner's basis in his or her partnership interest is $25,000. On December 30th of the current year, Paula receives a current distribution of inventory having a $10,000 fair market value, which reduces our partnership interest from 1/4 to 1/5. What are the tax consequences of the distribution to the partnership, Paula, and the other partners? Here we obviously know that this is a Section 751 distribution because she only received inventory. She didn't receive any of the cash. And we know we satisfy the 120% rule just by looking, because the basis in those assets is $80,000 and the fair market value is $140,000. All right, so it's going to look like this. The beginning partnership amount is over here. These are the value of the assets. Column 1 is her interest before the distribution when she owned 1/4 of the partnership. Column 2 is her interest when she owns 1/5 of the partnership. And then column 3, remember, is the hypothetical distribution. Had we made a distribution that is proportionate, a $10,000 distribution that is proportionate, but we didn't. We know that by looking at column 4. We only distributed inventory. So looking at column 5, the difference is $1,000. And remember, she received only inventory, so she is deemed as selling some of the inventory she received to the partnership for cash. So she has a deemed cash distribution of $1,000, and the partnership sale of inventory for cash, the amount realized is $100. Their adjusted basis in that portion of inventory is $800, so the partnership will have a $200 recognized gain on this deemed sale, and it will be allocated as follows. So these are the basis of the partners in the partnership. They all started with a $25,000 basis. You can see partner Q, R, and S are going to increase their basis by the share of partnership gain because of that inventory. So that's just $200 divided by 3. That's the only change to their basis. Paula, remember, has a deemed distribution of cash, even though she didn't receive cash, we pretend like she did, of $1,000. And then she also has a deemed distribution of she has an actual distribution of inventory, but we take the basis, the $9,000 basis of that inventory times 80%, because remember, we pretend like she only received 80% of her distribution in inventory. So we subtract the basis of that inventory from there to get her ending basis of $16,800. And then the basis that she takes in the inventory is going to include the amount she is deemed to purchase, $1,000. We are going to add the remaining distribution, the adjusted basis, the carryover basis from the partnership to get a total basis of $8,200.